You're marking up charts, spotting order blocks, but half the time, price ignores them, right? Well, let me show you how to stop guessing and pick the ones that actually work. Okay, so let's get straight into it. First of all, let's define really what order blocks are. So the theory behind them is that they are a footprint of institutional buying or selling. So on the charts, what we're looking for is either an impulsive move to the upside or an impulsive move to the downside. And what we're trying to do is wait for price to revert back to that point where that impulsive move was, and we try and get in at either a buy or a sell. In today's video, I'm going to show you a few examples and actually the best way to spot them and a few mistakes that people tend to make when they're looking at order blocks. So the first thing we want to do is spot where the impulsive moves have been. So on the chart, what we're looking for, and it doesn't really matter what time frame you use for now, and I'll explain that in just a second, but what we want to do is just go through with an arrow or with your cursor and mark where previous impulsive moves have been to the upside or the downside. Now, what does an impulsive move look like? Well, a series of consecutive bearish candles like this, or a series of consecutive bullish candles like that. Once we've done that and we've spotted where those impulsive moves are, we can basically start to say, where did that impulsive move begin? So I split out order blocks into supply and demand zones. Supply zones are basically bearish order blocks, so where we've had a bearish impulsive move, and demand zones are bullish order blocks where we've had a bullish impulsive move. What we're trying to do is mark the candle before that move started. So let me explain what I mean. Let's take this example. This is on the current price as well. There's our impulsive move to the downside. What we're looking for is the last bullish candle before the impulsive move to the downside. So if I zoom in there, you can see this green candle here was the last bullish candle before the move to the downside. We can now tag that or as a bearish order block, or I call it a supply zone. So we now know that this is a great resistance area for the price because that move that occurred is where it came from, was there, and we can look for something that looks like that, okay? Now, let's do the same for a demand zone. So let's scroll across to the left, again, looking at the current price, moving over to the left, and we're looking for an impulsive move. And you can see, there we have it, impulsive move to the upside. So there should be, in most cases, a demand zone, an area where that move began. So the last bearish candle before the move higher was there. So let me zoom in on that. This was basically the last bearish candle before the institutional buying, in theory, began. And we saw that impulsive move to the upside, okay? So we can tag that as a demand zone. And obviously this is a historic price level, so you can actually see how this one worked as well. So if I actually open a trade there, you can see, and we targeted the most recent high. That demand zone, that's the first demand zone I spotted on this chart, and you can see that the price went up and made a 4.3 to 1 risk reward trade off if you just bought off of that demand zone. Let me just talk quickly about like the mistakes that people would make. So I've just showed you how to spot them in theory, but there's a good supply zone and a good demand zone, and there's a bad one. The bad demand zones and bad supply zones are basically where people tag them even though the impulsive move didn't break any structures. So one of my golden rules is when you're spotting any of these areas, make sure the impulsive move that followed broke either a structure low or a structure high. So using these examples right now, you can see quite clearly that this current supply zone that we've got has broken this low here. That makes this valid because the impulsive move was strong enough for it to break through a low. Look at this demand zone. Here's where the move started. You can see that this demand zone was strong enough to break price above a couple of structure highs. That just makes this one more reliable, basically. What I see some people do is they will use supply and demand zones that are stuck within a range. Like, for example, here's a great example. I've literally just found it here. So we had an impulsive move to the upside, and you probably would have said, here's our last bearish candle before the move higher, and here's our demand zone. In fact, I'll replay that chart so you can see what it would look like. You would have looked at something like this. And you would have gone, there's our impulsive move. Here's our demand zone. We're going to buy from this order block, this bullish order block. However, you can actually see that we had more of a fake out above this high and not a clean break of structure. That means that this demand zone that we would have bought from was always going to be under threat. And therefore, if we went long at this level with a stop loss there, because that's typically how we would trade them, if I play that through, you can see price went down and hit our stop loss. And that was because the main reason, yes, there was an impulsive move to the upside. However, that impulsive move wasn't strong enough for a clean break of structure. This was more of a liquidity sweep on buy side liquidity. Okay, let's look at a fresh chart and try and find some more. Now, I just want to quickly talk about timeframes, because there's a lot of people out there who would trade order blocks on a 1 minute time frame, a 5 minute time frame. My typical rule is that I don't have a problem with people that do that. You're just going to get more losses. It's just a fact of using the lower time frames. They're a lot more erratic, and really institutional buying or selling, it doesn't really come from the 1 minute or the 5 minute time frame, in my opinion, and therefore you'll get a lot more order blocks that aren't strong enough and ones that aren't respected. Because just like any trading strategy, this doesn't work 100% of the time. Nothing does. You'll have a fantastic order block which you think, yeah, that's great, we had a break of structure, great order block to use, institutional buying or selling going on here, and you end up getting stopped out. That's just the nature of trading. You're never going to be able to avoid that. But you're going to get more of those on the lower time frame than you would if you use one of the higher time frames. Now, my favorite time frame to use order blocks for, and I've tested them, I've used them for years, the 4 hour and the daily. Daily order blocks are great. 4 hour order blocks, if you're a bit more of an intraday trader, are really, really good as well. So I'm on the dollar yen 4 hour time frame. So what I'm always looking for is I'm looking for a situation where I can see an impulsive move to the upside or the downside. So when I zoom out on this chart, there's a few examples. The one that really sticks out to me as I'm looking at the chart now is that one there for a bearish one, maybe this one here as well. And basically what I'm doing is I'm just going through on the chart and I'm just seeing, okay, where have we had a really impulsive move? Probably there as well. Let's use these two examples that I've currently got. We zoom in on the move and we say, right, okay, there's the prices come from here up to here. Now, where did that move start? What's our last bearish candle before the move higher? It's there, okay. Did it break a market structure? Yes, it did. Therefore, this would have been valid. However, as you can see, if we decided to go long there, with, to be fair, really, really tight stop loss, to be honest, and tried to target this high, you can see how much risk reward you get by targeting the most recent high, like basically the top of the impulsive move. It's a 17-to-1 risk reward. Okay, this trade didn't work out. It was quite unlucky, actually. It did end up moving in our direction, and there's potentially a re-entry here as well, which would be trading in good profit, but just would have been stopped out there. But the risk reward was great, and you can get such good risk reward from these order blocks. You know, you don't need to win 100% of your trades. You could win 30, 20% of your trades, and as long as your risk reward on the order block is like 5-to-1 or something like that on average, you're going to be making profit overall. In this example as well, you can see another example here, impulsive move. There's our bullish order block, okay? And you can see in this example, we would have entered long here. We can see we broke this structure high, okay? And look, 8 or 9, there's a 9-to-1 there. So even though we'd have lost that one where we tried aiming for 17-to-1, just before, if we would have been on the ball, nice order block there, bullish order block, break of structure, nice impulsive move, retested all the way down to the beginning of the move, and we'd have made 9-to-1 risk reward on that buy. And then what I recommend that you do is just go onto your favorite charts, go onto your favorite time frame. I mean, I always go onto the 4 hour or the daily time frame, and you'll find that there's some order blocks that have happened in the past which haven't been mitigated yet, and you can just leave them on your chart for another time. You can either set yourself a buy or a sell limit at these levels, or you can wait for price to hit them, wait for a lower time frame reaction, and then try and get in a more of a scalping method. There's different ways in which you can trade them. You can do it that way, or you can just simply trade off of them. I typically use other concepts like to marry up whether I like the supply zone. Like for example, I'll use other smart money concepts, liquidity grabs, fair value gaps, etc. But even just as a standalone strategy, really, really simple. Like anything with trading, if your risk management is there, you can see how you can get some really nice risk reward trades. And I would leave this supply zone in there for if at some point in the future we get this. Okay, so to summarize, order blocks, I split them out into demand and supply zones. Obviously, demand zones are where we're buying from and supply zones are where we're selling from. The golden rules really in which when we look to trade them is, first of all, make sure you're looking for those impulsive moves, and then did that impulsive move break a market structure? If yes, look for the demand zone or supply zone. If no, ignore it and move on. When it comes to trading, there's two ways in which you can do it. You can set yourself a buy or a sell limit at those order blocks, or you can wait for the price to hit them, set yourself an alert at those levels, move on to the lower time frames, and then you can look for a lower time frame break of structure and try and get in a scalping opportunity. Just remember, the lower the time frames you go, the less reliable any concept is, but particularly order blocks as well. So I hope you enjoyed this video today. If you did, feel free to give it a like, and you can drop any questions in the comment section and I will answer them for you. Also, I'm actually sending out trade ideas using these concepts such as order blocks into our Discord channel If you check the description below, you can get access to that Discord channel for free and chat to me all day about markets. Until then, I will see you for the next video.